in the portfolios that you do oversee, are you actively implementing gold and silver allocations right now?
Yes, we're long, and with new client money, we get more long for those clients, among other commodities that we're bullish on, like I mentioned, oil and gas stocks.
Welcome to the Alternative Edge Report. I'm your host, Olivia Voz, and we are touching base with Peter Boockvar, Chief Investment Officer of One Point BFG Wealth Partners. Peter, welcome.
Great to be here. Thanks for having me.
Thank you for coming on the show. Gold is obviously having the time of its life right now. So let's just start simple. Between gold and silver, which do you think offers more upside for investors?
Well, I would say on a percentage basis, it's probably silver from here because it's dramatically lagged the price of gold. Its relationship to the price of gold on a ratio basis is below its long-term average. So I would say silver. Silver does have sort of unique characteristics that gold does not have, and that's its industrial use. So it does have some more cyclicality to it, and that's why probably the moves are bigger. And also, from a central bank perspective, they're not really stockpiling silver like they are gold. So there are certain different characteristics of each. I think generally right now, both are taking a breather. It seemed that just a month ago it had sprinted too far too fast. And regardless of what the security is, when something goes vertical, to me, that's a red flag in terms of it getting extended and due for a consolidation, which is exactly what I think we're in the middle of right now.
I mean, you've been in the metals market for quite some time. When did you first get involved, and what initially convinced you?
Well, I started paying attention to gold in the 1990s and started to get really attracted to it when, in response to the blowing up of the tech bubble, when Alan Greenspan cut interest rates to 1%, which I knew that was a pretty artificial rate. And also it was not too long after the Bank of England puked all its gold at about $250 an ounce. And after 20 years of a bear market, I felt, okay, maybe there's something here. And that's when I started buying gold. And my current firm right now started here in 2018, and we were buying gold immediately then, and silver as well, and have held on since.
So you must be delighted this year with gold reaching record highs, but we also have equities like tech stocks surging. So how effective is gold as a hedge right now, especially with most investors still very heavy in equities?
Well, since the stock market peak in 2000, the S&P has underperformed the price of gold. That's over a 25-year stretch after outperforming gold in the prior 20 years, as stated. Gold is trading off its own sort of dynamic with the massive amount of central bank buying, and that's what really drove this last leg over the past 3 years. The Gen AI trade is sort of its own separate dynamic, and we know the reasons why. We know the not only the data center build out, but the explosion in prices to the upside with anything that touches this ecosystem. So I think each are sort of going in their own direction. And but at least in the short term right now, gold's pulled back with the AI stocks that have pulled back because when you get into November, no one wants to give up their gains. And I think everyone's trying to protect their gains. And that's why moves get exaggerated, just as when markets rally, typically at year end, no one wants to miss out on that rally as well.
Yeah, Peter. I mean, they call it no shave November, but it seems like the market is certainly shaving off some of their gains right now as we are seeing the general market pull back. There's obviously an undercurrent that's going on that's spooking investors. A lot of it has to do with the Fed, that they are predicting they're not going to cut rates, but maybe they will do a surprise cut. If the Fed keeps cutting rates, but inflation holds around 3%, what does that mean for holding precious metals, particularly versus cash or, short-term instruments?
Well, if that does happen, and they solely focus on the employment side of their mandate and put aside inflation's stuck at 3, well, yeah, that's going to be dollar negative, and that'll be metals positive. I think as Jay Powell still has 4 meetings left, and I don't think he's going to be that aggressive in cutting interest rates with inflation still stuck at 3. Now, if inflation decelerates, then maybe he will. If employment rate goes to 5%, maybe he will. But I think that at least the gold market may have to wait for who replaces Powell before they get an extended pace of rate cuts. So I still think that we can't get too excited in the short term as inflation's still stuck at 3, notwithstanding the growing concerns about the labor market. But I do think that we're certainly sowing the seeds for more aggressive Fed that will pay less attention to inflation and more so the jobs market, which then in turn raises the risks of higher inflation. And if you look at the long end of the yield curve, that they are certainly more focused on the Fed losing its attention on inflation. Because when you think about the Fed funds rate falling 150 basis points since September 2024, well, the 10-year yield is barely down since then.
I mean, back in 2011, 2012, also U.S. debt was a major driver for gold, tying this in. Today, that issue obviously still exists, and we have increased geopolitical risk. So it's not just the Fed debt, but we also have war in Ukraine. We have some, tariff threats. How does that influence gold's trajectory from here?
Well, I think worries about debts and deficits is a key factor in why foreign central banks have certainly reduced their exposure to U.S. dollar. I think tariffs also had an effect on that too, in the sense of us starting this trade war with the rest of the world. But debts and deficits now matter everywhere. Well, I shouldn't say everywhere. In many places. It matters now in Japan, if you look at JGP yields. It matters in the UK, seeing what's gone on with gilt yields. It matters in France. It matters in Germany. And with sort of investors being more risk averse when it comes to taking on too much duration, gold is an important sort of asset replacement for that fixed income portion of one's portfolio, and that portfolio including the portfolio of central bankers.
Peter, you mentioned you've been into metals since the 90s. We had some pullbacks throughout the years, especially in 2015. What made you stay in that trade when you saw a lot of people exit during that time?
Well, it certainly wasn't fun, and it was a time period that I thought would last forever. Luckily, it didn't, and interestingly enough, gold bottomed just as Janet Yellen was finally taking interest rates off 0 after 7 years, stuck there. It wasn't easy, I have to tell you. But I looked at the 1970s as another example of a gold bull market, and the gold bull market back then was interrupted by around a 50% sort of decline in correction. So I felt that as long as the fundamentals that I felt was pretty powerful defined as a world of negative interest rates, 0 interest rates, and massive QE, that downturn in gold was more of a temporary thing. And luckily, I stuck with it and, in fact, added to the position.
Oh, nice. So instead of diamond hands, you had golden hands, a true player.
I did. Can you tell the color of my eyes?
Yeah, exactly. Well, Peter, on top of gold, we are seeing more countries even move towards using gold and the reliance on the dollar, the debasement trade as well. If someone wanted to act on that trend today, what's a practical step for them?
You mean basically positioning for that trade?
Yes.
Well, it's clearly hard assets, and the ultimate hard asset with the longest sort of tenure, call it, is gold, of course. I mean, 5,000 years, you've been through a lot. And I don't know what else is out there that has stood that sort of test of time. But hard assets generally, even platinum, we got long platinum about a year ago. And that's another hard asset that people can feel comfortable with if fiat currencies continue to lose purchasing power. Silver, of course, as well, and a barrel of oil and so forth.
Let's move to cash. You've described cash as optionality. How should investors balance that with physical gold and silver, especially if they're concerned about losing purchasing power over the next decade?
Well, I understand people like, oh, how can you own dollars? But you need dollars to take advantage of dislocations in the market, and that's where the optionality thing comes in. Uh, and like that's the thing about bull markets and bear markets. In bull markets, everyone is fully invested, and if you do enter a bear market and everyone's fully invested, you don't have cash to take advantage of their bear market. The beauty of bear markets, and I know beauty is sort of a strange word tied to bear market, is that it provides an opportunity to buy things cheaper. So I always think it's important to have, especially in a world where asset prices are very elevated, is to have cash to take advantage of that inevitable decline. And now, of course, everyone has to calibrate that allocation amongst themselves and what is most comfortable for them. Now, broadly speaking, of course, you don't want to own too much cash because of that debasement. But I think in a portfolio, having that dry powder, I think, is always good to have.
I hate to make this dag joke, but I got to say it's the silver lining of the bear market, the silver lining that we're seeing here. Peter, in the portfolios that you, I had to do it. I had to do it. Real quick, in the portfolios that you do oversee, are you actively implementing gold and silver allocations right now?
Yes, we're long, and with new client money, we get more long for those clients, among other commodities that we're bullish on, like I mentioned, oil and gas stocks and fertilizer stocks and uranium, and in addition to gold, silver, and platinum. So yes, we are, and this sort of pullback and rest that we're seeing, I think, is a pretty good opportunity to add to it. Again, acknowledging that this pullback can be more, can be deeper, but I don't think the bull market is over.
All right, so you like gold and silver with some weight, even in this current condition.
Yes.
Okay. All right, Peter. Well, let's say we have 5 years. What would you say your one conviction trade is for that time period? What would it be?
5 years, I would say a barrel of oil at $60. Obviously, I do believe the metals will go higher, but I'm not smart enough to know the time frame. I know in terms of something that's really cheap, I think a barrel of oil is one of the cheapest assets on the earth right now.
Liquid gold. It's named that for a reason. Yep. It's just too easy to. Yeah. Oh, Peter, thank you so much. Thank you so much for taking the time to meet with us today. It was a great catch up. I'm excited to see what the market's going to bring and have you back on as a guest. Really great convo.
Thank you. I appreciate having me on, and it was fun.
That wraps up the Alternative Edge report. Make sure to like and subscribe so you can stay sharp and ahead of the game.